My name is Andrew Betwain. I'm the editor of InsuranceInvestor.com, and today I am joined by Christopher Granville, who is the managing director of TS Lombard. Christopher will be speaking at our Insurance Investor Live conference in London on November the 3rd, and he'll be speaking on a panel about what are the economic drivers and what are the pitfalls around inflation versus stagflation, the new geopolitical risks post the Russia-Ukraine crisis, and the COVID pandemic. Christopher, thank you for joining me this morning.
Andrew, thanks for inviting me. Looking forward to the conference in November.
Thank you very much. All right, I'm going to dive straight into the questions. So could you give us your thoughts on the wider economic picture at the moment and what investors in insurance specifically, or in the financial services sector, need to be wary of?
Well, it's a one-word summary of the situation. Stagflation, you just mentioned it yourself, Andrew. This is the toxic mixture, the worst of all worlds, high inflation and low growth. And the question for all financial market participants, and particularly I would argue in the insurance sector, is how far authorities will go to stamp out inflation. Are they ready to drive the major economies of the world into recession for the sake of overcoming the intense inflation pressures? And here, sitting here in the UK, we've got a peculiarly toxic version of stagflation, the highest inflation and the lowest growth among the major OECD economies. So how far are the authorities going to go? And one of my colleagues at TS Lombard, our global macroeconomist, Dario Perkins, has just published a note. You can probably pick up the summary on his tweet thread, which is entitled "Whatever It Breaks." A nice play on words. We all remember Mario Draghi, Super Mario at the ECB, whatever it takes to prevent deflation, the collapsing asset prices, breakup of the Eurozone. Now, whatever it breaks. It looks like the central bankers of our time, whose psyche is conditioned by the previous stagflation shock in the world economy, almost half a century ago now in the 1970s, that with that psyche, they are determined to avoid a repeat. It may be a case of generals fighting the last war, as generals so often tend to do. It looks like they are ready to do whatever it breaks. If we have to have a recession to get inflation down, that they are ready to go with. So that's really, I think, what investors need to be wary of. A 1970s experience that was a nightmare for financial asset markets. The very difficult to secure returns. Managing long-term portfolios, as in the insurance sector, is going to be all the more challenging. Cash will tend to be king with interest rates going up, but even now interest rates, with the most rapid pace of monetary tightening seen since the second inflation shock of the late 1970s, but those interest rates still remain below inflation, so they are negative in real terms. There could be a long way to go. We're speaking on a hot summer day here in London, Andrew, and as we get closer to the conference in November, things could have changed. Inflation may have begun to ease off because already we see some harbingers of much weaker economic activity, particularly in housing demand. But I'd be delighted to be wrong, but I think as we get closer to the conference, this very tough and challenging picture, which I've been sketching out, will by and large remain in place. And we still see tight labour markets, continued considerable wage pressures, and in the United States in particular, the makings of a renewed credit cycle. It looks like central bankers will have to take that hammer and get into that whatever it breaks mode. So that's I won't go on further. One can get overexcited or over depressed about this and go on and on. But I hope that's a reasonably clear answer of what investors need to be bearing in mind.
Thank you very much for that, Christopher. I'd forgotten about the Eurozone crisis. That was at least 3 world-ending crises ago. So building on that, you mentioned inflation versus stagflation, and I want to build on that idea around specifically insurance and the other various pricing pressures. So what are the key things that insurance investors and those in the market should be looking out for in this area?
I think it's very important to understand the origins of this inflation shock, and they are embedded in the previous shock. As you mentioned, the shocks come so thick and fast, Andrew, that they can crowd one another out. But of course, I think we're all none of us are going to forget in a great hurry the pandemic COVID-19 shock, and that's where you need to look for the origins of so much of what is going on. In that pandemic period, on the demand side, you had authorities doing their best to prevent their economies collapsing, despite the fact they had physically closed down so much activity. So this meant very intensive monetary and fiscal stimulus. So there was demand in economies. What was that demand? Where was it to be directed? What were people going to spend money on? Well, services were shut down. We remember in the UK, they reopened the pubs for a time a couple of years ago, and then they had a new COVID wave straight away. Well, that was pre-vaccinations, wasn't it? So there was only thing to spend it on was goods. And a lot of manufacturing had drained down inventories because the global economy seemed to have stopped. So you got this big supply whiplash effect, and it took a long time to crank up supply of all the goods that were in demand. Supply chains were creaking. We all know the stories, and that obviously created an inflationary dynamic. But then you had to overlay onto that a massive new supply shock, which came from geopolitics. I mean, already the growing tensions between China and the US had interfered with supply chains in some ways. But when you had the Russian invasion of Ukraine and the retaliatory sanctions by Western governments, you then had huge uncertainties about the supply of energy. And not just energy, but on energy, remember that Russia is not like Iran. I mean, Iran has been sanctioned to the hilt for years. It's a petro state, but the volumes are not the same. Russia is 10% of global oil production, and the largest producer of natural gas. But it's not just energy. It's many other metals, minerals, especially agricultural commodities. So the effect of sanctions in casting doubt on major supply, of course, has had this price shock in the global economy. And I guess that what we should be looking out for, of course, is any easing of that. Normally, as is often wittily said, that the cure for high oil prices is high oil prices, meaning that if the oil price is high and stays high, people can't afford to buy so much. They have less disposable income, demand goes down, inflation comes down. But the trouble is that because of that demand impulse from the pandemic period I just mentioned, the starting level of demand is high. So if you imagine like a video game where you're batting away at a monster, it's going to take a long time to erode that high level of demand from and meanwhile the geopolitical pressures which are generating this supply side shock are very persistent. There's simply no solution in sight. This is a long-term war of attrition, both the shooting war, the physical war, and that part of the war which is economic and financial, called sanctions. So should we be looking out for anything here? Well, perhaps I would look out for any move by the United States and its allies to reduce risks on the energy supply side. It looks like the Biden administration is not that happy with the European Union's oil embargo against Russia, thinks this could be very globally inflationary and damaging. And that's not surprising. They've got an election in America coming up just about the time of our conference, the same week, if I'm not mistaken, the midterm elections, with inflation, especially gasoline prices in the US, an absolutely key issue for voting intentions. And also, there is the threat of of gas being cut off from Russia to Europe this winter. So it looks like some Western governments may want us to, without in any way compromising on their positions of principle as regards Ukraine's right to territorial integrity and not to be invaded and so on, that the governments will ease things. So one thing I'd be looking out for example, would be whether Canada will release a sanctions impounded, this is sounding a bit detailed, but wait for it, gas turbine, which will ensure sufficient pressure of gas through the existing gas pipeline under the North Sea from Russia to Germany. It sounds like a small thing, but you know, the pebble starts the avalanche. If that can be reinstated by a sanctions waiver, then there'll be less chance of a major gas shock in Europe this winter, and other such tactical maneuvers to reduce the risk of a even more potent stagflation shock. So I don't change my overall view. The macro view is that there is a severe risk of a hard landing, meaning a recession, looking out 12 months. In the case of the United States, we at TS Lombard think probably in early 2023. But things to look out for is, could we get an even more severe shock, and will governments intervene to provide some relief? So that's what I'd say on that question.
Interesting. There's a lot of detail there and some very interesting insights. So I wanted to build on that slightly. You mentioned there about the Biden administration. You mentioned the sort of government regulators. So in the shoes of the ECB, the Bank of England, the Fed, do you expect much sort of broad level regulatory involvement for the financial services sector over the rest of 2022? And how are they going to possibly affect the markets and the economic conditions that we're in?
Well, we've got used, haven't we, to regulators intervening massively since even before the great financial crisis of 2008, thinking right back to the Greenspan period, intervening massively to support financial markets. The notorious Fed put, the put option offered by the Federal Reserve, then markets were weak, they would ease financial conditions to keep asset prices and confidence stable, if not rising. So that's what everyone's got used to. But as I said earlier, Andrew, that there's now a risk that authorities are so concerned to prevent an inflation spiral, a wage price spiral, losing control of inflation, and wanting to knock inflation on the head, that they may just not only tip the economy into recession, but allow markets to crash. You know, a bear market so far, we've had say 20% fall from the peak of the S&P 500 benchmark index, equity index in the US, in major bear markets lasting for more than a year. The typical peak to trough fall is much higher, say 40 or 50%. So I'm looking at your questions, what are regulators going to do? But I think the bottom line is that they are ready to inflict pain, but they do not want to have financial instability. They want to ensure that financial markets can continue to function in the sense of intermediating savings. So they're not going to freeze up by complete lack of confidence, concerns among market participants about the viability of their counterparties, potential domino effects. You know, memories are short, but again, the memory of 2008 will live with financial market participants and professionals probably for the rest of their professional careers. So I think that there is probably no longer a Fed put, but there is probably some kind of backstop. But if I may, I'd just like to attack your question from a longer term angle. You said in the rest of 2022, but I'm going to give myself the right to look out a bit further. It's clear to us at TS Lombard that we are entering a new so-called paradigm. Now, after a decade or more of ultra low interest rates, or even outright negative interest rates, for example, in the euro area, and persistently low inflation, we're entering a period of higher interest rates, higher cost of capital, just more demand for capital, particularly perhaps in relation to the transition towards net zero greenhouse gas emissions for the sake of trying to avoid a climate catastrophe. Now, in those conditions, regulators will need to allow capital to be mobilized, especially for climate change related investment. And I think that again, this is much longer term than your question on the rest of 2022, but perhaps we'll get some debate on this at the conference. It seems that, just to take one slightly parochial example for us sitting here in the UK, the post-Brexit UK authorities are minded to revise the so-called Solvency II regulatory framework for insurance companies' investment activities with a view to liberating more capital for long-term investments, and clearly a desire here in the UK to see more savings, in particular that chunk of the national savings which is intermediated by the insurance industry, more of that going towards long-term capital-intensive investments. And I think the regulators, to make that happen, it's not enough simply to allow insurance company balance sheets more flexibility than in the previous European Union regulatory environment, which also incidentally may move in the same way. There's Brexit is Brexit. Brexit means Brexit, as some politician said the other day. But generally, things tend to move in parallel in the advanced economies, developed markets. So it's just more than just balance sheet flexibility. It has to be some kind of protection of returns. So people managing long-term insurance-related portfolios for, say, life products and so on, can see that if they're getting into some energy project, if it's nuclear power, if it's the hydrogen power, electricity storage, then there is some protection of returns or on a regulatory framework. I think it's a vitally important theme. It fits with the economic environment. It fits with the climate-related imperative, and it will be very relevant to investment activities, I would argue, perhaps particularly for the insurance sector. So I've just taken a liberty there. I've just gone off on a slightly new tack, taking us well beyond our November conference, but I hope that was interesting.
No, it was basically a macroeconomics degree in 10 minutes. So that's a fantastic answer. Thank you very much, Christopher. So building on that, for my final question, we've talked about all the doom and gloom for the past 3 questions. I wanted to ask you, before we let you go, are there any upsides to the current situation in the current economic climate that maybe is flying under the radar that people should be aware of? So any good news out there about the economy and about the future of investments?
Well, I guess that well, first of all, thanks for the question. So important. It's so easy simply for analysts and commentators, people like me, just to go with the flow of the what everyone's thinking about, the zeitgeist. Stagflation is the worst mixture, and we can settle for gloom and doom. And we look smart. We can't go far wrong if we predict bad stuff happening, and no one is going to complain or criticize. But it's always important to break out of the groupthink, to step back, to consider alternatives. So, as I said, a great question to end with. And, the first thing I'd say is I was mentioning earlier that there's a danger here of, like in generals fighting the last war, that central banks are going to be reacting to what they think is a repeat of the 1970s. But today's conditions are very different from the 1970s. We simply do not have the basic ingredients for a wage price spiral that existed back then. There were two factors there. First is that you had labor militancy, and that has, although there are going to be strikes, especially in the public sector, which has been very hard done by across the advanced economies, again, particularly perhaps in the UK. So there will be labor unrest, there will be some militancy, but you're not going to get that across the board withdrawal of labor or disruption because, well, first of all, because of regulation, the trade union power has been largely broken. But more importantly, for an economic reason, is that the other thing in the 70s was that economies were much more closed. This was pre-globalization. Employers had pricing power. You could simply, if you had militant workers demanding more wages, more often than not, you could pass on those extra costs and to your customers and defend your margins. So that's why you got the wage price spiral. But now, if you can't pass on your costs because someone else will eat your lunch, perhaps especially some competitor in a fast-growing emerging market in Asia, for the sake of example, and you'll simply go out of business. So does that sound like good news? Well, what I'm saying is that a persistent stagflation, a decade-long agony like we had in the 1970s, looks very unlikely. This could go two ways. The authorities could overdo it, and we could get into a recession, but then it'll be just a normal recession. Investors in the insurance sector and elsewhere will have to buckle down, get into cash, and the storm will pass and we'll get a new cycle. Or because we don't see these traps of a wage price spiral, you might get even a chance of a soft landing. So inflation will simply come off because of demand destruction and we'll avoid an outright recession. So what I'm saying is that if you get a recession or if you don't, there is a silver lining here because we can get out of this more quickly. Regardless of whether you think the policy makers their choices are optimal or not. So I think the bright side is that that this is more likely to be a storm that will pass, even though while it's going on, it won't be pleasant, than a protracted agony, as I was just saying, like the 1970s. So that's the best I can do for the bright side. Doesn't sound perhaps as bright as we'd like, but I think it offers some corrective to the gloom and doom, and I hope that's interesting.
Thank you very much, Christopher. Well, that was actually very interesting. So lots there to discuss, lots there to unpack. So if you found what Christopher was saying interesting, please do join us at the Insurance Investor Live Europe Conference on November the 3rd in London. Christopher will be speaking on a panel around the economic drivers and pitfalls around inflation versus stagflation. And I'd like to thank him for his time today and for his insights. And if you really do think you want to hear more, he will be there at the conference, as will I. So thank you very much to Christopher. And my name is Andrew Petwain. I'm the editor of Insurance Investor, and I hope to see you again in the future. Thank you very much and have a great day.